Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And today I want to talk about a very, very important question that I get all the time. And I'm sure that if you're, getting older, you're nearing retirement or you're in retirement, you've asked yourself this question, you asked your financial advisor or planner this question. And I'm here to say that the answer or the conventional wisdom that you got to this question is probably BS. It's probably a bunch of nonsense, in my opinion, of course. The question is, how do you manage your investments, or what do you invest in when you're retired? Can you actually stay in stocks, in the stock market, 100% in equities or in stocks in retirement? And I think the conventional wisdom, and even spoke to my parents about this, their financial advisor, when they used to have one, said, when you're retiring, you have to decrease the risk of your portfolio, maybe not be in stocks 100%, go in bonds, fixed income, more stable assets. And that's the conventional wisdom you'll probably hear from your financial advisor or planner, right? You got to de-risk as you get older, as you near retirement. But that's a bunch of BS and could hurt you tremendously. And I saw a clip. This was a very interesting clip because Dave Ramsey was on Fox Business, and they're talking about, this is about 10 days ago. This is when the market was going crazy with the Trump tariffs, et cetera, big swings in the stock market, a lot of volatility, a lot of, stock prices going down 10-15%, the S&P, the Nasdaq in a short period of time. And let's watch this clip together. So at the beginning, he's talking about like general wisdom that you hear all the time. But then the host asks a very, very important question, the question about retirees that are worried about their portfolios and that are not working anymore, and should they stay or can they stay 100% in stocks? And his answer was very surprising for two reasons. Let's check it out together. First of all, the clip.
Welcome back. A majority of Americans hold stocks. The Federal Reserve, which releases a report every 3 years on household finances, shows that a record 58% as of 2022 have a stake in the stock market.
Which is why it is understandable that recent market turbulence has...
I'm happy to see that the number is going up, by the way.
People panicking over their 401k retirement funds, but we have ridden this roller coaster many times before, and our next guest says the only ones who get hurt are the ones who jump off in the middle of the ride.
Yes, Ramsey Solutions founder and CEO and...
I love that expression that Dave Ramsey always uses. The stock market's like a roller coaster ride, but the only way to get hurt is if you actually jump off the roller coaster, aka sell your stuff.
Author of the book, Build a Business You Love, Dave Ramsey, joins us now. And we're so happy to have you to hear some calm in this little bit of a market panic storm, Dave. Ultimately, people get scared. Their instinct is to sell when you've hit a bottom, when the best thing that you could do is hold on, not really focus on the volatility. We don't have a systemic problem here. It's a policy-driven issue right now that probably will work itself out.
You're exactly right. I mean, David, you remember you and I did a little thing for a couple million people called Town Hall for Hope in 2008. Well. And we flew out to Oklahoma City, and thank you for that. That time the Dow went from 13,000 to 6,700. Don't you wish you'd bought at the bottom there? Oh, my goodness.
Absolutely.
And so, yeah, around here we just say real investors take the long view. So if you freak out, zoom out. Back up a little bit.
Real investors think long term, take the long view. When in doubt, zoom out. Look at the stock market or the S&P or the Nasdaq, nonetheless in the last couple of weeks or couple of days, in the last couple of years, right? Not the last couple of weeks.
Let's say, okay, the S&P 500, last 25 years, we've had 6 down years. 2023, we had a 26% rate of return. 2024, we had a 23% rate of return. In the last 5 years, including today, we've still got a 78% rate of return. That's a 15% average annual. Oh, remember the Fauci pandemic when the market dropped 34% in 2 months? 2020? Fully recovered and made a 16% rate of return that year, the other side of that little dip. And that was a deeper cut than we've seen in the last week or so. So calm down. You didn't lose your money, and you don't lose anything till you sell. Just ride the coaster like
you don't lose anything till you sell.
You said, and pan back and look at the big picture. Where do you really believe America is going to be 5 years from now? Oh, a lot better off than we are today.
So you never sell in a panic. I think we all agree on that. But the question is when you buy in, and you mentioned those sweet spots that we wish we could have bought in at. And we've got a chart. There's something called the VIX out there. It's a volatility index. When that goes way up, stocks go way down. There are 3 times in the past 35 years that it hits that 60 point way up there. And one of them was 2009. You mentioned that when you and I got together. That was the financial crisis. Spring of 2020 was another one, the pandemic. And then another one was yesterday. So is now the time to buy?
Probably. I don't know what the bottom of this is. Obviously, none of us have a crystal ball. And really, the research tells us that those who try to time the market generally don't do a good job, because we generally jump out at exactly the wrong time and in at exactly the wrong time. So let me tell you what I'm doing. Constantly investing like I have for 40 years. And it's made me a lot of money.
I bet.
Fantastic answer, guys. I hate getting that question. I still get that question all the time. Is this a good time to buy? Like Dave Ramsey says, guys, you got to take a long view and you have to buy consistently over time. That is the best strategy. I will go even a step further and say the good time to buy as a long-term investor is always the same thing, as soon as possible, right? Because the markets go up over time. You have to have a long-term view. But here comes the actual question that's very important relating to this video about retirees and can they stay 100% in stocks. It's very interesting what Dave Ramsey says here.
It has, and as you mentioned in those stats, market stats, a lot of people have made a lot of money. But people who are closer to retirement are going to be a little bit more nervous than somebody who's younger, who has a longer time horizon and can wait it out for that recovery. And I'm not, disparaging people who are invested in stocks and they're close to their retirement age. But shouldn't you, at a certain point, Dave, start to also think about not having as much risk in your portfolio if you plan on retiring soon, and diversifying, maybe looking at bonds as another option to have a little bit more safety, because some of these folks are fully invested in stocks and now they want to retire. That might be a little difficult.
There's the $1 million question, right? Do retirees have to go with bonds and get rid of their stocks?
It really, no, I haven't adopted that theory. I'm 64. I'm staying fully in the market.
Wow.
And here's why. If you've got a 401k and you got $1 million in it, you're not really going to touch the $1 million. You're really going to live off of the 80 or 90,000 a year that it produces in income. And so it's not like that. And if you're 64, by the way, statistically, the actuarial tables say you're going to be living until 92. So you still got 30 years to outpace inflation. You screw around with the bond market and a bunch of quote-unquote high-yield savings products, you're not even going to outpace inflation for that 30 years. So, no, I'm staying fully invested. I haven't bought off on that. That's a standard financial planning viewpoint, but I don't buy into it. I'm fine with it because, again, you didn't lose your money. I had people say, I lost all my money. No, you didn't. You may have lost 20% of it, but only if you sold. The classic Buffett line of, I didn't lose anything because I didn't sell anything.
Well, it's a lot of great points there. First of all, he's talking about how GICs, high interest savings account, even the bond market sucks. We all know it sucks, the bad guys, has low returns. So he says to stay 100% in stocks. Obviously, he talks about how conventional financial planning is that you de-risk your portfolio. I think it's a bunch of nonsense. But what I would love for him to go into detail and what surprised me is he's saying if you have $1 million 401k, which is, in Canada, it's the RSP, you're not going to be touching that capital. You're going to be living off the income and getting 80, 90 grand. Hold on a second. $1 million to get 80, 90 grand, that's 8-9% yield. So I would have loved for the host to ask him, how exactly are you getting that income by not selling, right? Because if you just have $1 million in the S&P 500, that only has 1.2, 1.3% yield. You're not making 80, 90 grand, Dave Ramsey. So exactly where is that yield coming from? Of course, if you're super rich, like Dave Ramsey, you could probably get 80, 90, $100,000 if you have $10 million, right? If you have $10 million in the S&P 500, you'll make 100 grand a year or a little bit more than that. But if you only have $1 million, you're only making like $10, $11, $12,000 a year, right? Because it's 1%. So this is where I would have loved for Dave Ramsey to explain further. But maybe Dave Ramsey's secretly a PII investor, because everything he's talking about, not touching the capital, that's kind of the PII mantra. So I want to touch on a few points here. This is where I believe the PII system, covered call ETFs in particular, solve this big problem that all retirees have. So to be able to live off $1 million, you can't put it in the S&P 500 unless you got to sell your units. You have to sell shares, which is something you want to avoid. To live off $1 million and get 80, 90K a year, you need 8, 9, 10% a year. So the S&P 500 doesn't provide that. And this is where the covered call ETFs solve this problem. If you get an S&P 500 covered call ETF in Canada or in the US, you can achieve those yields. You have USCC, 12% yield approximately. USCL with a bit of leverage, 15% yield. You have ESPX from Evolve. These are Canadian ones, by the way, which is about 12, 13% yield. You have FEPI from Fidelity in Canada, which is about 9% yield. HYLD, which is about 14% yield. In the US, there's a million S&P 500 covered call ETFs. You have GPIX, which is about 8% yield. SPY-I, very, very consistent 12% yield. IVVW, which varies monthly, but the yield is, the average, I believe, is maybe 15 on average every single year. Make that 12.6 in the average for the last 12 months. You have zero DTE covered call ETFs like XDT, which pays out monthly. You have iSpy from ProShares. You have T-Spy, which is at about 14% yield. So there's no shortage of options where you could invest in the S&P 500 with a covered call overlay and get that consistent yield. So maybe Dave Ramsey is a secret PII investor, but I think this guy's like a 100 millionaire. So of course you could live off 1% if you have $100 million. But my point of this video is the covered call ETFs, covered call strategy, make it so retirees and anybody actually in any age group, even as you get older, to stay 100% in stocks forever. And that's really what you need, because you never need to sell your capital. So you're going to be okay stomaching fluctuations with your capital, with your portfolio value, because you're never touching it. You're never selling anything. You're living off the income. If you're making 9, 10, 11, 12, 13% yield, you could easily live off $1 million retirement portfolio. You never have to sell units. So this is I call it the drawdown problem that the FIRE movement has, that typically invest in passive index funds. They're only drawing down 4% to make sure it lasts them 25 years or whatever. Covered call ETFs solve this problem. Also, a big problem it solves is the return. It's the performance. Financial planning, conventional financial planning and wisdom, you need to de-risk your portfolio, go in crappy bonds and GICs and all that crap as you get older. Guess what's that going to do? What that is going to do? It's going to kill your returns. We know that the stocks or equities is the best performing asset over time in the world. They beat bonds, they beat gold, they beat real estate, they beat everything except for Bitcoin, but we'll see what happens with that. But anyway, that's another video. So this is a way, the S&P 500 returned about 11% annual return in the last 40 years. 40 years. Bonds don't do that. GICs definitely don't do that. So that's what he's saying about you're not even going to beat inflation. You're probably not going to beat inflation. If you Google or go on Wikipedia or Investopedia with best way to beat inflation, number one thing it says is invest in stocks, guys. This is a way, the covered call strategy is a way to stay in stocks forever, no matter how old you are, without killing your returns. You don't have to go in those crappy, safe assets, low-risk assets, which typically translates to crappy performance that don't beat inflation, right? Also, another thing is that they're the income that you get in Canada is capital gains income and ROC. Even in the US, the majority is ROC, return of capital, which means delayed capital gains. So you're getting, it's not ordinary income or dividend income or interest income like bonds give you. It's capital gains income, which tends to be very, very tax efficient. That's another advantage. Another advantage is psychological protection. You're not going to panic sell if you know your income's coming in next month and the next month. So it's much easier to stomach stock market volatility and quick crashes and small crashes and corrections, etc., when you know you're getting paid every single month. And that's exactly what these covered call ETFs do. They pay every single month. All of these have not missed any dividend. Yes, they could fluctuate. This is where you have to do a little bit more investigation to figure out which one is best for you. The key with the covered call strategy is how much upside am I giving up? When you're doing covered calls on anything, in layman's terms, remember guys, you're giving up some upside for that income, which is that downside buffer and downside protection. So each fund manager is going to be different. Normally, the higher the yield, the more upside you're giving up. The lower the yield, the less upside you're giving up. So this is where everyone has their preference. GPIX has about 8% yield. SPY has about 12% yield, but SPY writes more covered calls. You're giving up a little bit more in upside, right? So this is where everyone has to see, what their preference is. But psychological protection is what the covered call strategy gives, right? You're not going to panic sell. You could stay in the market forever if you're just living off that income. You get consistent income. And these managers, especially in Canada, even in the US, guys, they know that people want the reliable income. This is why the distributions don't fluctuate much, and this is why they're very, very consistent over time. You guys know that I review these ETFs every single month on the US side and on the Canadian side every single month. This is what I invest in, what I have my money in, what my parents have their money in, my grandparents, and they never have to sell anything. They're just reinvesting as much as they can and living off the income they need. So I just wanted to make a quick video to say, this is a very important question I get all the time, and Dave Ramsey kind of answers it without really answering it, but I'm answering it 100% on how to do it. He says, if you have $1 million retirement fund, you're not living off the capital, you're not selling anything, you don't lose unless you sell, all that conventional stuff. But I wish you would have explained, okay, how do you make 80, 90 grand off $1 million portfolio? It doesn't really go into that. Well, covered call ETFs solve that problem. It's a way to stay in equity, stay in the S&P 500 or the NASDAQ 100 and get that income. So your performance, you'll get similar performance to the S&P 500, maybe a bit less, right? Because covered calls, you're capping your upside, so over time the market goes up. So an S&P covered call ETF will have less return and less performance most likely over time versus just the S&P 500, but it's not going to be a drastic change versus going into bonds, which has like 5-10 times less performance, right? You'll maybe get 5-10-15% less performance over time, not 60% like bonds, right? So this is a way for retirees to stay invested in stocks 100%. This is where I can't stand conventional financial planning and wisdom. Those covered calls or that monthly income gives you the courage and the ability, even as a retiree, to stay in 100% in the best performing asset class in the world, stocks, forever. So give me a thumbs up. I would really appreciate it. Do you agree with me? Do you disagree with me? If you do disagree, let me know what your plan or your solution is. Have you had an experience where your financial advisor, you ditch your financial advisor who said, oh, you retire, you got to go to bonds? Because I think that's pretty common. And if you are interested in these types of ETFs, you're a bit newer, first time watching a video, my channel, Passive Income Investing, focuses on income-oriented investing with a focus on covered call ETFs on both the Canadian stock market and the US market. So if you're interested, make sure to subscribe. Thanks for watching, guys. See you next time.